I heard Yellen is going to be on Bloomberg today, but I haven't found when she's going to be on today. I'm still looking. If I find it, I'll get it posted. But for now, just kind of keep keep that in mind. Not very helpful, I know. All right. Good morning, everybody. We've got a lot of data out of Europe this morning that sent us to the downside. Markets have tried to bounce back from that. They got the gap closed. That's a good start. Just have to be mindful of the fact that now that it's closed, we could turn around and go back down again. On the other side of that, however, is the idea that there's two ways we see these events with gaps happen, where we get the news, it drops us or pops us. We move back, get the gap done, and then the market goes back to doing whatever it was doing before the event happened. On the other side, whatever the direction was of the original push, the markets start to take over on that direction. So we were inside day breakout and then failed it. So if we get inside day breakout again, then we'll resume that march to the upside. We're going to get the 2-year tomorrow, and then the 7-year, well, the 5-year this week. Those aren't really the ones that I hold in high regard, but it's still data. So don't sleep on those. A lot of Fed speakers going to be coming out, chipping their teeth, all singing from the same hymn book. Powell's supposed to have a pre-recorded message coming out this week as well. So just a lot going on. Government shutdown possibly averted. And that one is the closest thing that could impact the markets in a big way. It was supposed to be resolved by the end of the month. So if they can get that out of the way with a week to spare, that'd be pretty cool. But we don't have it yet, right? It needs to be done. So markets trying to stabilize after the Europe data. Japan up the most, 1.25. I was just looking at the carry trade. It's down, but trying to turn back again. So just a little bit of instability. See 3 different Fed speakers today: 8 o'clock, 10:15, 1 o'clock. (9:45), we have PMI. It's another part of that gut punch. So it's going to be that kind of day where it seems like we just keep getting hit with more and more and more data. really front end auctions, you could watch the IRX, the 13-week, and see how these two affect the curve. They shouldn't really, but whether or not it's a good auction, watch the tail. Japan overnight, we're going to get a speech. Remember, he's leaving and they're going to replace him. And then there's still the issue with, are they going to raise rates or not? They really bowed down to the market. And well, and now they're just the whipping boy, but we'll see. You see that carry trade trying to come back. Dollar and 2-year not working together. VIX still sitting between 15 and 20. No significant change in structure there. Breakout and breakdown levels for the day. They're not much of a surprise, and I've already posted the picture. Simple little roadmap. We don't have today's spot gamma report yet. When we get it, though, I will share it. Looking at the ADRs, we're sitting pretty much flat. You see our position this morning, not even 0.1%, really. We're holding above VWAP. That's about all we can say about it. At this point, it's a coin toss for which direction we go. A lot of talk over the weekend about this being a honey badger day. I'm new to the phrase myself. It doesn't fit into what I generally do, but it's the idea that there's some structure out there that that indicates, even before the markets Sunday night opened up and gave us data, that that today would be a dip and then rally, and that the rally would take us back to, say, the open or the close of yesterday. I don't know, you can do a little search on honey badger days if you want to learn more about it. It's really no different than any of the other strategies that I've picked up over the years. Even if I don't want to trade it, knowing about the strategy provides more insight into how I want to do my own trades, my own approach. So take a look. Company called The Big Short has a lot of blog posts on it, and they have a particular niche in their tools that spots honey badger days. So there is that. The ADR really hasn't expanded all that much. We've been looking at it at 71, 72. Now it's at 75. But, you know, around the second week of August, it was at 102. So it's still down from where it was. Central pivot range this morning. This wider range down here, that's the weekly pivot. The narrow channel this morning, that's the daily. It's the one that we want to pay particular attention to. One, it's inside of Friday, so that's kind of a neutral stance. It is slightly higher than Friday's pivot if we just look at the floor pivots themselves, but it's a minor amount. There's no real edge here. If it was widely gapped, that would be different. It is a narrow day if we compare it to yesterday, but it's not the narrowest day that we could get. The narrower, the better. It can get so narrow that you don't even see yellow lines. You just see a purple line. You don't even see a box. That's how narrow it could be. And so it's not that narrow. The idea behind these central pivot ranges, CPRs, is that if it's a wide range, the likelihood of a breakout working, and then we continue the breakout in the direction of the breakout is high. So wide range breakouts fail, narrow range breakouts work. That doesn't happen because of the pivot, right? This pivot doesn't make us break out. It doesn't make us keep going. If we do break out and it doesn't turn us back, it's giving us insight on what we should expect the market to do if we break out. So Friday, for an example, was a really wide channel and we didn't go anywhere. We didn't break out. We didn't break down. We held the line, went into the close, which was the base case argument Friday for the morning briefing. That was my go-to default position, was that we were just going to hold the line and go into the close nice and quiet. We actually almost pinned 5,700 on the SPX, which Spot Gamma had pointed out was the pin point for the day. They almost got it, and it was pretty darn close. 5702, not bad, right? That's pretty darn good. Holding above the weekly pivot point like this puts us in a bullish bias. But of course, just to put that into some context, this was the weekly pivot last week. If things had turned negative and we had started to fall from, say, way up here, and we were just falling and falling and falling towards that pivot, we wouldn't say, oh, well, we're still above the weekly, we must be bullish, I'm going to go look for long trades, because it would be obvious that we were just falling like crazy, and we would forget the idea that we're above a weekly pivot because everything would be showing that we're continuing to fall. So, put it into context. Yeah, we're above the weekly pivot. That puts us in a bullish bias. Yes. But we don't want to ignore things that say we need to flip over and run short. We got 2 Ds for last week's profile. Remember, we can have a lowercase b and we can have an uppercase P, but we don't have an uppercase B. We don't have that. Instead, we have a D, and then we have another D. And the lower D is where we have the profile. So a continued move to the downside around 5,700 is where we find the profile from last week with the point of control. It's a high volume node or high volume shelf, but it is a bit of an air pocket of risk to get down there. So below 5,750 puts us to 5,700 pretty quick. If that structure doesn't hold, then we'll reevaluate, but 5,550 doesn't look bad. That's some fun numbers. We really don't have much volume structure above us. So if we try to retest that 5,800, it'll be about the liquidity on the dome, not about old volume and volume structure. We're above the 0 gamma and the volatility trigger. 5809 or 5811 cog line is the call wall. I believe they rolled the put wall down, looking at the spot gamma report from the PM edition. Rolling the put wall down is not bullish. It's not necessarily bearish either, but it's not bullish. Bullish would be rolling it up, in my opinion, to give them like a springboard to bounce off of, right? If you've ever tried to climb a pegboard, for an example, you want to keep moving your pegs up, be kind of the same way, right? You don't want to move it in the other direction. It doesn't help you climb. The gamma index moved considerably. That'd be this zero gamma line. So we'll see. I'm still waiting on the AM edition. We'll see what they have to offer. We're above the 3-week, the 10-day, 20-day. So no moving averages are in our path. The volume's a little concerning. So this lower indicator, it doesn't matter what I have on the top, right? I could put anything up there. This indicator isn't looking at that, right? It's a standalone thing. It's looking at the NASDAQ. This is called the Cumulative Volume Index. And if you're on TradingView, rather than just looking at the NASDAQ, you can look at, quote, all US indexes combined, which I think is better than Thinkorswim's, only looking at one index. But either way, regardless of that, the NASDAQ's a pretty big deal, right? It's tech. So in this run up over the last 3 weeks, because this is a weekly chart, what we've seen here in the cumulative volume is a continued move to the downside and a flattening out underneath all of the moving averages. So we're not getting supported with buying volume, even, quote, net buying or net selling. Put it on a daily, it doesn't look any better, right? We had that nice run up from the lows. So, you know, September 6th to the 19th, we see that run up, and then a significant drop to the downside Thursday and Friday. Not sideways like we see in price. So that's some net selling going on under the surface. May notice I added some lines down here to the overnight volume. So every day we look at the overnight volume, see what the net volume is. Just gives us an idea of what kind of participation we had in the overnight hours. This morning it's at 81. But I also added some of these other levels. I could put them on the regular chart, but they're kind of noisy, right? So I tucked them down below so they'll stay the heck out of the way. And yet I can be reminded of where they are. Market open and market close, these different zones for Asia, Europe, US, Australia, right? It's a cycle that goes on around the world. As I've mentioned before, by the time we do the morning briefing starting at 7:30, half the trading day is already done. I know new traders don't quite grasp that yet, but the trading started last night at 6. So we're past 6 this morning. Half the day is already over. TradingView's got a pretty good indicator for it, but you do got to kind of adjust it a little bit. Someone turned me on to this one from Lux Algo. It's called Sessions. So if you search for that, you can find it pretty easy. You just have to adjust the times a little. There's a company called tradinghours.com that you can go to and get this information for free. Which markets are open today, which are closed because of holidays, what time they open in their time zone. So it uses GM plus whatever. And if you have a hard time understanding those different time zones, use AI. If you notice, if we look at Fridays, the Tokyo high, the London high, the US high, that wasn't the Globex high. We never made it to the Globex high. And it was because of Tokyo and London. When we ran up, we kept hitting that pivot point and we couldn't get through it. Useful to know, right? Nice to have that little bit of insight. Yeah, it's pretty noisy. Once I get the levels that I need, I tend to turn it off. $10-day, 30-minute volume profile. We've got a volume shelf building at our location, this 5770 area. It's not enough yet to move the point of control, and it won't move it anytime soon if we're looking for it to move as the volume disappears. That won't happen for a week. We won't see this middle section start to get eroded until, Friday into Monday, Tuesday, next week. So the only way this point of control is going to move before that is if we build up enough volume here. And that's absolutely possible. We stay within Friday's range, today's range, and just chop here for another day or two, and we'll see this point of control move up. If we drop down, then 5700 has this structure, just like when we were looking at last week's weekly profile. 5700 has structure. Below that, we've got a serious pocket, air pocket that can drop us down into 5632 cog line and even down into 5550. It sounds familiar, right? Because that's the same numbers that I was giving when we were on the weekly. We don't have a VPOC to carry over from Friday. I don't think, yeah, we don't have any overhead either. Just this VPOC at 5624. We're a long ways from that. The point of control on the TPO and the volume profile both up at the highs. Any move at this point to the upside is going to have to work through all of that volume structure up there. Trader's remorse, unfinished business, whatever you want to call it, a breakout to the upside is going to be difficult. It was also a measured move right into a liquidity zone, and we stopped right where we should stop, which is pretty awesome the way that works. All right, we measured the range on Friday in the morning, but it wasn't set in stone yet. The box doesn't set until after the close on Friday. Now that it is set, we can kind of compare it with the last week's volatility, and we can see that they're almost identical. The current week's volatility is as high as last week's, and last week we had FOMC. We are 1% above the 10-day moving average. That's a good spot for us to be. We tend to do really well within that zone. We don't want to get above, say, 1.5. That starts putting us into negative pressure. It makes it harder to go up once we're up that high. And we don't want to get too close to the 10 to the downside, because we're more likely to gravitate to it at that point, right? Start chopping around the 10 as a structural level. So 1%, 1.25, that's a good place to be. It answers that question. Are we overbought? Did we run too far last week? Nope. Does it owe us any sort of pullback, mean reversion, least squared method? Nope. Looking at the 10-week, we're sitting at about 3%. That's about where we want to be. Any more to the upside and we'll start having negative pressure it'll get to that point where it's so much harder to move higher just because we really are starting to push against our limits for mean reversion and how far away from the mean we are. So make no mistake, we can go higher. It's just going to be difficult to go higher from here without at least some sort of pause first. Now, I say pause, but another word for that would be correction. Generally, you hear the word correction, you think downside, but we can correct in more than one way. We can correct through time, just staying right here, letting things heal and stabilize, or we can correct through price. And that would be a move back in the other direction towards the 10-week. We're not overbought. We're not at extremes. We're just getting to that point where getting higher than, say, 3.5, getting to the 3.5 would be fine. Getting past that, expanding more, it'll take a lot of effort, a lot of news, some sort of event, some change in market dynamics that would get people that bullish that they're willing to push it when we're already 3.5% above the 10-week. I don't see that kind of catalyst on the forecast this week, but doesn't mean we can't get something. So hold the line and pause here at these highs, or pull back and digest that big candle of last week, that Wednesday FOMC day, or Thursday, I should say, it was the day after FOMC. We could sit and digest that for a little bit. That would give the 10 time to catch up to us. And that would be our correction in time rather than a correction in price. Staples down 1.5, healthcare down 1.25 over the last 5 days, but everything else is looking okay. So a bit of a capital rotation again. One of the things I continued to hear over the weekend is a focus on earnings into 2025 and how corporate profits should do better now that the Fed has started to cut. And if they don't, well, I mean, that kind of says it all, doesn't it? Because if they don't, then it's going to be a smackdown. We still got to play it level by level. And right now, the news, we've got some earnings events today. None of them are big economic indicator kind of earnings, like Walmart is an economic indicator when it reports. Since it's one of the largest employers in the world, people tend to pay attention to it, what it has to say about current spending and, you know, their outlook on the economy. So that's one. FedEx is another one, and FedEx didn't have a good earnings, but there's some extra in there, right? The whole thing about its deal with the Postal Service, and I mean, there's just some outside influence on the FedEx report, but some earnings are more important than other earnings. And Cintas is one that's reporting this week, and it's one that I pay particular attention to. It's well, it's a lot of different things, but I've seen it as a uniform company. I've worked at some really dirty jobs in my life, and some companies would pay Cintas for their uniform. They would deliver the uniforms each week and do the laundry on the dirty uniforms and then bring them back the next week. When times are good, they're one of the best uniform companies you can get. So when times are good, companies hire them, but it's pricey. And when times are bad, well, they get rid of the pricey uniform company and they bring in some junk local wannabe mom and pop company that can barely keep up because they're cheaper. So Cintas in its reporting this week is going to be one of those bellwethers on how companies are doing. Because companies will cut that, right? It's not like electricity. They got to have electricity. They'll skimp when it comes to uniforms. Nat gas up, Bitcoin, and almost to our limit is the China ADRs with the KWeb constituent. Baba, Baidu, JD, PDD. Mag 7s are trying to move around a bit, but they're also not up enough to meet our benchmark. So we can see gold, for an example, gold miners, hard drop on their head, trying to rally back up, but they're inside day. So at the very least, we got to get outside of yesterday, and it's not looking good so far. Pot stocks are showing that they're positive, but one, it's just an algo print, just a little dot up there. They're not actually getting flows. And two, this is still a very seriously beaten down space, and it's not time, right? It's certainly not time. Nat gas, yeah, but you don't want a market rally based on, solar and nat gas. So sure, we're getting that breakout above 15. It looks good. We're going to hit our head up here at around $17 on this anchored VWAP. If we can even continue the drive to the upside, that's a big if. And I don't want a rally from, junk like that. We want a rally from the Mag 7 space and solid names, and the index is not nat gas. FXI, that's China as well, inside day breakout. Red to green too, no less. This thing has made some really big moves in the last week or so. But if we zoom out, it's still got structure that it has to get through back here. A lot of resistance in the way. I just use this more as an indicator than I do for something that I want to trade. I don't generally try to trade something that moves more after hours than it does in the regular trading hours. China ADRs, the KWeb group, also up this morning, getting a little bit of flow. Generally, you see these up and you want to ask which group is doing it or which company, if there is just one. So taking a look at something like JD, it's up inside day breakout, kind of stalled. PDD, it's not that. Baba, a little bit of a pop to the upside. It couldn't get that breakout. Baidu also slightly up. It couldn't get the breakout. So JD is causing that love this morning. It's got to carry the whole thing by itself. Kind of hard to see it pulling that off. Plus, this is a really big structure to get through. Even if it can make it to the top, that's a sell zone up there, 29.50. If it can even get there, it's going to be a lot of sellers waiting to finish some business. Bitcoin's up. It's had a nice run in the last few days, or even the last week or so. It's been not bad, but we're not seeing it in the proxies like I would have expected. Lower highs and lower lows when we zoom out. The structure is still clear. The trend is still very obvious. We have to get all the way up to this 21 and get above it to set a higher high and then pull back from there and run up again so that we can set a higher low. We don't have that, not one higher high and one higher low. And you need two higher highs and two higher lows for a full set and a trend change. We don't have any of that. This is still a beaten down turd. Uranium's moving around decent. That was a solid push Friday, but right up into unfinished business. So if we can break through that Marbozu bar from Friday and make a run for it, we could get up into that anchored VWAP 29 area. I'd say it needs to hold at least 50% of that Marbozu. So if we continue to see weakness this morning, keep it above 26.75. Otherwise, if we cut through that, then we'll run it back to 26, and then we'll see. Getting a little bank love this morning, but it's just an algo print. There's no follow through on it yet. Industrials, banks. There's talk about this rally widening out finally, right? Remember, most of the year it's been a Mag 7 thing, and then they went on pause, and we've seen some other markets come into life, really forgotten places, XLI, XLP, XLU, XLB. So those forgotten ones, started to come back, and then they went under pressure. We're looking for all of them together. That would tie in with a few analysts that say we're on the next leg to the upside. Most people right now are screaming from the rooftops over all the bricks that are in the wall of worry and how it's a ticking time bomb before this all collapses around our ears. But there's people like JC Perez from All-Star Charts. He's not one of those that are saying we're headed to the downside. He's not even one that's talking about a ticking time bomb. He's one that's pointing out all the reasons why, or all the reasons this could continue moving to the upside. Not XLI per se, but markets in general. There's always bricks, right? The wall of worry is a wall, right? Not a temporary barrier. There is always bricks in the wall of worry. So nothing in these sectors this morning tell us that we're going to see some significant change in market dynamics. We've got econ that is front and center, way heavier than these sectors. And we need data. How the market absorbs that data is going to put us on track for the day on whether or not we hold the line and stay sideways within Friday's range, or we break out. And if we break out, we've already got levels in place, and we just trade what we get, right? Just keep in mind that Yellen is supposed to be on Bloomberg. I haven't found when yet. I caught it out of the I just barely caught it when they said it. So I'm trying to track down when. Don't know that she's going to have anything to really say either, but we're getting closer to the QRA. So if she's going to start dropping hints and chipping teeth, I want to hear it. Otherwise, watch the clock. Look for one of these sectors to start to dominate. Preferably one of our three. So consumer discretionary, technology, finance. We really got to have at least one of those three. We can't get a good, clean, sustained market rally without at least one of them. And preferably it's finance, consumer discretionary, or tech. Because finance, I mean, it's got its own issues right now. So I really don't want to see a market rally based on finance today. Take it as an assist, but not as a leader. Well, I thought there'd be something left in here, but we got nothing in here. So a dollar above 101.5 should cause some issues, or dollar below 100 now that that 100.2 has been tagged. If we break that low and actually get down into double digits, like 99 and that area, then the market's likely to feel it. But we got to get through that, right? One side or the other. Basically, Wednesday's high or Wednesday's low. Until we do, the dollar is just going to chop around down here, and it's not very likely to cause any sort of impact into the market whatsoever. Basically ignore it if it stays in that zone for right now. That's one less thing you got to focus on at the very least. And crude starting to roll over just a little bit on this big candles half back. If it can get through that and continue to move to the upside, all good. But if we see oil start to break down, 70 should be fine in the 70 range. If we get under 70, I'd see the market get a little nervous. And then if we get underneath this 65, yeah, we're going to feel it. But that's so far off, right? Just getting under 70 would be a pretty big deal. It would be breaking through this half back from Wednesday. So that's an easy one to focus on. $70. And for the upside, getting through the half back of this day. 72. All right, that's what I got, guys. Be careful, be safe, watch the clock.